In the world of geopolitics, the ongoing tensions between Iran and Israel are a ticking time bomb, waiting to explode. This conflict, with roots deeply embedded in history, religious ideologies, and political power struggles, has far-reaching implications that ripple across the globe. The Iran-Israel conflict isn't just a regional issue, it has a significant bearing on the global economic and political landscape. The main focus of our exploration today is the impact of this conflict on the US stock market. Yes, you heard it right. The ripples of this distant conflict reach the shores of Wall Street. The financial markets, with their sensitivity to global events, react and adapt to these geopolitical tensions in ways that can significantly affect investment portfolios. The Iran-Israel conflict, therefore, is not just a topic of interest for policy wonks and news enthusiasts. It's equally significant for investors who navigate the choppy waters of the stock market. Let's delve deeper into the roots of this conflict and see why it holds such significance. The Iran-Israel conflict is not a battle that erupted overnight. It's a complex web of historical, political, and religious factors. Let's delve into the deep roots of this conflict. The discord between Iran and Israel stretches back to the mid-20th century. After the establishment of Israel in 1948, Iran was one of the few Muslim-majority countries that recognized Israel as a sovereign state. However, this changed dramatically in 1979 with the Iranian Revolution, which marked the beginning of an era of hostility. The Iranian Revolution, fueled by religious and political fervor, replaced the pro-Western monarchy with an Islamic republic. This new government viewed Israel as a usurper of Muslim lands and began to actively support anti-Israeli groups, adding a potent mix of religion into the political stew. Fast forward to the 21st century, and the conflict has only intensified. Iran's controversial nuclear program has been a significant point of contention. Israel, fearing a nuclear-armed Iran, has expressed its concerns on the global stage, leading to an escalating war of words and covert operations. On top of this, the proxy wars in the region, specifically in Syria and Lebanon, have added another layer of complexity. Iran's support for Hezbollah in Lebanon and its involvement in the Syrian civil war have put it directly at odds with Israel, leading to sporadic and often violent confrontations. Recent events have thrown fuel on this already raging fire. The assassination of Iran's top nuclear scientist, allegedly by Israel, and the retaliatory attacks on Israeli shipping in the Persian Gulf have pushed tensions to a boiling point. But why should we care? Well, this conflict doesn't exist in a vacuum. It has far-reaching implications on the global economy. The Middle East is a critical geopolitical region, home to a significant portion of the world's oil reserves. Any disruption here can send shockwaves through global markets, making this conflict a concern for every investor, regardless of where they're based. So let's take a closer look at how these geopolitical tensions can affect the global economy, and more specifically, the US stock market. Why does the Iran-Israel conflict matter to the global economy? Well, the answer lies in the oil. The wheels of our global economy are greased by oil, and Iran, undeniably, is a significant player in the oil market. The nation sits on the world's fourth largest proven oil reserves, and any conflict involving it could potentially send shockwaves through the global economy. Imagine how the constant tension and occasional flare-ups between Iran and Israel could disrupt the oil supply. The Strait of Hormuz, a slender but strategically crucial waterway located off Iran's southern coast, sees around 1/5 of the world's oil pass through it every day. Any military action that could close this vital artery would have serious repercussions on the global oil supply, causing prices to skyrocket. An escalation in oil prices sends a ripple effect through the global economy. Higher fuel costs can increase the price of goods and services, from your morning cup of coffee to the flight tickets for your summer vacation. This in turn can lead to inflation, and central banks around the world may be forced to hike interest rates in response. This could slow down economic growth and potentially lead to a recession. Let's also consider the impact on the stock market. Energy companies, particularly those in the oil sector, could see their profits swell when oil prices rise. However, other sectors like airlines, manufacturing, and logistics, which heavily rely on oil for their operations, could see their costs increase and profits squeezed. Moreover, the broader market indices like the S&P 500 and Dow Jones, which include a range of companies from various sectors, could also feel the heat. Higher oil prices could dampen consumer spending and corporate earnings, leading to a drop in stock prices. In short, The Iran-Israel conflict has the potential to create widespread economic turbulence through its impact on the oil market. Now, let's narrow down our focus to the U.S. stock market. The ripples of the Iran-Israel conflict reach the shores of the U.S. stock market, influencing it in both direct and indirect ways. The direct effects are perhaps the most obvious. Let's consider the energy sector. Iran is a major player in the global oil market, and any disruption in its oil supply can send shockwaves through the stock prices of energy companies. As tensions rise, the fear of possible disruptions can cause energy stocks to swing wildly. This can also ripple out to the broader market indices, as energy companies make up a substantial portion of these. But it's not just the energy sector that feels the heat. Defense and cybersecurity companies often see their stock prices surge in the face of geopolitical tensions. The rationale is simple. Conflict often leads to increased defense spending and a heightened focus on security, pushing up the demand and consequently, the stock prices of these companies. The indirect effects, on the other hand, are a bit more insidious. They stem from the uncertainty that such conflicts breed. Uncertainty is a foe investors universally dread. It makes the future look foggy and decision-making tricky. When investors can't predict what's around the corner, they often retreat to safer assets, and stock markets can take a hit. A classic example of this is the stock market reaction during the Iran crisis in the late 1970s. The conflict led to a global oil shortage, skyrocketing oil prices and a surge in inflation. This sent the U.S. stock market into a tailspin, with the Dow Jones Industrial Average plunging more than 45% over the course of 2 years. However, it's important to remember that while conflicts like these can cause short-term disruptions, they don't change the fundamental strengths of the U.S. economy or its companies. Over the long term, the stock market has proven to be remarkably resilient, bouncing back from geopolitical shocks time and again. But what does this mean for investors today? Well, in the face of heightened geopolitical risk, diversification becomes even more crucial. A well-diversified portfolio can help absorb the shocks and minimize losses. It's also a good idea to keep a close eye on the news and stay informed about the evolving situation. Investors should also consider their risk tolerance. Those with a lower risk tolerance might want to consider reducing their exposure to sectors that are highly sensitive to geopolitical risks. On the other hand, those with a higher risk tolerance or a long-term investment horizon might see these periods of volatility as buying opportunities to scoop up quality stocks at lower prices. But how should investors navigate these choppy waters? That's a question that we'll delve into in our next segment. Stay tuned. In times of geopolitical tensions, smart investment strategies can be your compass. Navigating market volatility, especially one stemming from geopolitical unrest, may seem like a daunting task. However, with the right approach, these periods of uncertainty can present unique opportunities. One such strategy is to diversify your portfolio. Having a mix of different investment types can help cushion against market volatility. Another strategy is to consider safe haven assets, like gold or government bonds, which typically perform well during times of instability. Furthermore, keeping an eye on sectors indirectly affected by the conflict, such as energy, technology, or defense, can also provide investment opportunities. Lastly, remember the value of patience. Markets have historically recovered from short-term volatility, so avoid making hasty decisions based on daily news cycles. Remember, staying informed and actively managing your investments is key in these turbulent times.